Hey there, I am David Greene, host of the BiggerPockets Real Estate Podcast, here today with another Morbid Mondays Here with another episode of the Mortgage Monday show for you. Listen all the way to the end of today's show if you want to understand why that joke makes sense. You'll probably laugh. In today's show, we are going to get into some red alert information, things that you may not have been aware of that can really get you hurt in real estate, stuff that Christian and I have been seeing because we are sitting in the crow's nest of the real estate ship. We see the problems happening long before they would ever come your way because we work in the mortgage industry. We also sell houses, so we are privy to stuff in real time. So if you're like on the ground journalist, like wartime correspondents here, so you're gonna love today's show if you're someone who doesn't like losing money. Check it out. Christian Bachelder, my partner in the One Brokerage Company broker. Happy Monday to you. How's it going?
Pretty good. You as well, David.
Thank you for that. Today's show is going to be a little bit different. Now, normally we at BiggerPockets tend to focus probably 80 to 90% of our content on acquisition strategies. We look for creativity. We look for market updates. We look for where their soft spots are in the market to build wealth through real estate. Well, in today's show, we're focusing on defense. We're going to talk about ways that people have been getting hurt in real estate investing and how you can avoid ending up in similar situations. Now, there's always a new way that people can get hurt, right? We see rising interest rates have contributed to a lot of people getting in trouble with real estate. Maybe you see in the short-term rental space, a lot of people flooded the market, nasty Karens and NIMBYs popping up, complicated things. So this isn't a new part of real estate investing. There's always been trouble, but this is a unique one that we haven't seen for a long time because rates have been lower. So tell me a little bit about some of the things that you and I are kind of seeing from the crow's nest of the lending industry that we are sounding the alarm to everybody else to pay attention to.
I don't want to be a fear monger here, but this is something that we're seeing an uptick in that for a long time, lenders, realtors, everyone in between has told you not to worry too much about. The nasty due on sale clause, right? That's the one that everybody's always known, is in the back of minds, and it doesn't really get checked, and lenders don't care as long as you make your payment. Us here at the One Brokerage are seeing an uptick in our clients that we've represented, and not so much of the due on sale clause being called, but investigations being opened. And what that means is that if you bought a primary residence, for instance, this is one example, that you intended to live in. You have 60 days to move in and you're supposed to live there for the first 12 months. Lenders are checking to make sure you did that, right? And in some situations, they're seeing the house posted for rent the next day or on Airbnb or whatever the case is. In this time in the industry, I can't stress enough the importance of, just like David shared, a defensive investing strategy. Because if you put 5% down and you bought a primary and that note gets called due, you either got to sell it or you got to refinance it as an investment. And that requires 20% down. So you're gonna have to bring 15% post-closing to bring your loan up to current. That could kill investment strategies. So that's number one. The second option is with illegal title transfers. And anybody who, gets a conventional mortgage, you basically say you're gonna hold that note through the maturity of the loan. You're gonna be on title. A lot of people quit claim to their LLC. A lot of people, with subject to financing, I know, transfer to another individual as a buyer, but keep the mortgage in their name. We're also seeing a couple of those getting inquiries about calling it due if that person is no longer on title. So a couple of situations to look out for some of our creative investors.
Now, this is something that's always been a possibility, but it's never been a practicality. Lenders just were not paying attention to this type of thing because as the value of real estate was going up more and more and more, and as rents were going up more and more and more, and as vacancy was going down more and more and more, the overall risk of foreclosure was decreasing to the point of almost nil. When you compare like traditional foreclosure numbers, it's been very small for the last 7, 8, maybe 9 years. So lenders haven't been as worried about what you're doing to the property because in the worst case of a foreclosure, they could just hand it to an agent and have it sold in 2 days for more than what you paid for it. Well, now the market is slowing down a little bit. There's a little bit more uncertainty in the economy and the market. Rates are going up. And so they have an incentive to look into making sure that you're doing what you said you're going to do with the property, right? They're not guaranteed that it's going to be worth a lot more than what you paid for it because the market isn't as increasing at the same pace that it was. But there's another Easter egg in there to pay attention to, and that's that rates are going up. And I've been talking about this for a lot to the people who have been using creative financing subject to anything where a due on sale clause could apply that nobody was considering would make a bank care, and now they're starting to care. So Christian, can you talk about how interest rates going up may make it in a bank's best interest to foreclose on a property or call the due on sale?
If I just break this down into basic terms, it makes a lot of sense. So, imagine, a bank, let's just use like SVB as example, right? Because that's the bank that recently failed. They were not a mortgage bank. So they didn't have a lot of loans out in terms of mortgages. So they went and bought all these bonds and they had to realize massive losses. Well, imagine if you're also a lending bank, why would I go sell my assets at a loss when I can look internally at the mortgages that I hold at 4.5% from 2 years ago and potentially prove either some illegal title transfers, which FYI guys is incredibly easy to find, right? It's very easy to find who owns a house, right? If you have a realtor or whoever, and banks have that information, right? They can pull title and see, hey, we gave a loan to David, but now Christian owns the property. What happened here? We don't know who Christian is.
Yeah, because the title has to be recorded with the county assessor's office, which is public information.
Correct.
Christian and I are both real estate brokers. In 4 seconds, we could look to see any property's address, who the owner of that is, and you don't need any kind of skip tracing or anything like that.
100%. They gave a loan to David to buy a property, but Christian is now on title. Who's Christian? We never underwrote him. We didn't approve him for a loan. So they would go to David and say, hey, David, we give you a loan at 3.5%. We see that you, against our loan guidelines, transfer title to the property. You still owe us a loan. And now that you don't own the asset anymore, we're going to call your loan due. And imagine that lender that gave David $1 million to buy that property. Instead of going and selling all these bonds to get their money, they're just going to go call David's loan due. And you got 60 days to pay it back, or we're taking the house, with the appreciation that's happened the last 2 years, which is pretty good. Banks being in a liquidity crunch may bring more of a focus on this. I know, like we shared in the beginning, we're seeing an uptick in it. And I can't help but imagine that the recent liquidity crunches and runs on the banks and all that are probably having some impacts here.
Now, there's another little angle to look at where you made a great point. Someone like Silicon Valley Bank, they put all their money into bonds. Now they have a liquidity crunch. They need to raise capital to give back to their investors because everyone's asking for their money. They can sell the bonds, but they're going to sell them for a discount because rates have gone up, and now you can buy bonds at a higher interest rate than what they bought theirs at. So how are they going to get that money back? Well, they call the mortgages due, and it doesn't take very long to find that. What happens if banks then say, you know what, we don't want to buy bonds anymore because we saw what happened to Silicon Valley Bank. So it's crazy that like the safest investment ever is now considered to be risky because we've raised rates so quickly. But they say, hey, we don't want to have a bunch of money come flooding into our bank because we don't really have anywhere to put it. And we can't pay interest to our depositors if we are not earning more interest than that, or at least the same lending the money. So let's not get more money coming in that is in higher amounts than the demand we have to lend it. What we should do instead is go to all of those 3% loans that we made for $1 million and say, oh, you actually sold the title of that property. You weren't allowed to do that. We're going to call that $1 million due.
But we'll offer to refi you at 7%.
Yes.
Exactly.
Yep. We'll refinance you at 7% instead of 3%, and either you lose the entire property or you say yes. Or if you do sell the house, they then get back that money that they lent at 3%, they go lend it at 7%. That would make a lot of sense for a bank to do. It reminds me of that line in The Matrix with Morpheus where he says, that sounds exactly like the thinking of a machine to me. I would expect for this to happen at some point. In fact, I hope none of the bankers are listening to our YouTube right now. I don't want to put any of the ideas in their head, but you could be very, very vulnerable. Now, imagine if we continue to raise rates. Imagine if mortgages hit 12%, right? And you got a loan at 3%. This becomes exponentially more likely to happen the more they keep raising rates. Now, as of very recently, rates went down a little bit, so we all kind of exhale. I wouldn't do that long term. I think that the Fed has shown they will do whatever it takes to stop inflation. They believe raising rates can do it. Inflation is continuing to go up. They're going to start raising rates again. We need to get used to the fact that probably for the next several years at least, we are going to see them increasing rates as much as they can humanly get away with, which means this is a bigger risk that we want you to be aware of, especially with the trend right now in subject to financing. It seems like everywhere I go, the question everyone is asking is creative financing, creative financing, creative financing. I don't have any money. I want to buy real estate. How do I do it without any money? Well, you could take over someone else's mortgage. Is this something that you've seen as well, Christian, with people that are coming to the one brokerage and they're supposed to be coming to get a loan, but they're coming and asking, how do I take over somebody else's loan?
There is strong aspects of the strategy. A huge problem too comes when you're trying to combine conventional financing and seller financing or creative financing or subject to whatever the case is, right? Fill in the blank. Because these things don't play very well together. The problem is circulating around this due on sale clause, right? You did something against the lender's intentions. Now you want to come and get a loan for either the difference of the down payment or the equity in the property, whatever the case is, right? And you're basically telling the lender, hey, we already don't care about the lending program, but can we get a new loan?
Yeah.
Right? And they don't mesh very well. So sometimes people get these really good deals in subject to, but there's not really a clean exit strategy. You literally just have to sit there and like pay off the seller's loan over the remainder of the course of his loan term, right?
Yeah, and if you haven't bought a lot of real estate before, or if you're not familiar with the X's and O's of this stuff, like most people aren't going to be when they first get into it, it's very easy to catch you when you're trying to do this because When a lender gives you a loan on a house, especially if it's a bigger lender that's going to have the best rates, like the people that Christian and I are going to put you in touch with, they want to be in first position on that loan. What that means is if there is a foreclosure, they get paid their money first. All right. And then you can get additional loans that are in second position or third position. These would be like a HELOC. A HELOC is a loan you get where there's already a loan in place. We call it being subordinate to the existing loan, which means if there's a foreclosure, your HELOC doesn't get their money back until the first lender gets all of theirs back and the HELOC gets whatever's left, which might not be the whole amount. So the loans become increasingly riskier for the lender the lower that their lien position becomes.
Yeah.
Now, when you already have a loan in place on a house, you took it over subject to, that loan is most likely in first position. You can't go get a loan from us or a credit union or anyone else and say, I want a loan in second position. They're going to say, no, we don't do that. That's too risky. Okay, well then you can be in first position. That's not a choice you get to make. The original lien holder has to agree to go down lower, which now is telling them, hey, you did something that you weren't supposed to do. Why do you own this property anyway? We gave the loan to John and you're Joe. This doesn't make sense. So what we're seeing is the red flags pop up incredibly easy because liens are recorded with the county. So it's not hard to find them.
Yeah.
What advice do you have for the people that have been hearing about creative financing and it sounds really good, but there may be more to the story that they don't know? Where do you think they should start to get educated and what's their best bet?
Yeah, I definitely say get educated just with the risks and the rewards of it, because there's absolutely people who achieve a lot of success with it. I would say even if you're not intending on getting a mortgage, talk to a mortgage professional, because you may be canceling out some of your possible exit strategies by implementing this enter strategy, right? This entrance. Make sure that you're understanding everything that you're taking on with subject to, with creative financing, with seller financing, whatever it is, because it could block what you eventually want to do. Real estate is not just about your first move. You know, anybody who's done a BRRRR, the most important part of the BRRRR is the refi out of it, right? It's not the hard money loan to get it. Those are easy. It's getting out of it, right? With a good 30-year fixed mortgage. So if that's part of your strategy, even if you're not using a mortgage and you're committed to using this concept of subject to and seller financing, still get guidance from somebody who knows the risks of it.
That is a great point. Another thought I had the other day, when I was a kid, my favorite author was Michael Crichton. He wrote the book Jurassic Park. He wrote another book called Sphere. I thought he was really cool. I didn't have any way to talk to Michael Crichton. Like, you'd have had to figure out where his address was, write him a letter, put a stamp on it, and hope that he wrote it and took the time to write a kid back, which isn't very likely to happen. Today's world is incredible. We can read a book and we can DM the author and actually get a response that same day. It's wild. We're just used to this, right? It's not a normal thing. So people that are listening to this right now, you can actually talk to Christian or I about the stuff that you're hearing and the questions that you have. You could do so in the comments here on the YouTube channel. Just let us know. What are you thinking? What questions do you have? What concerns you have? What did we not cover here? Or, Christian, if people want to talk to you directly, what's the best way to get a hold of you?
Yeah, my direct email is christian@theonebrokerage.com. Our website's available at theonebrokerage.com. You can also reach out to me about getting involved with our company Discord, where you have nonstop access to me, David, our team members. We're talking all the... David and I were just doing a couple shout outs in there right before recording this. If you're interested in that, reach out to me on my email. We'll get you an invite link and you'll be a part of our world.
That's right. We are in that Discord all day long. We keep it open on our computers and we are frequently staying in touch with former clients, staying in touch with new people, and just spreading the information because it's changing so fast. You really got to be plugged in or you could miss out. So please do look into that. And also, thank you for joining us here on Mortgage Monday. We are committed to bringing you what's going on in the mortgage industry, things that you may not know. And like today's show, landmines, things that you could step on without even realizing that you did, and you don't realize it until your leg's been blown off. We want you to keep your legs, so make sure you subscribe to the channel and catch us on future shows. Christian, thank you very much for your time. I'll see you next Monday.
You as well, David.